I think it's important that when you're taking a look at the change from LIBOR to any other risk-based reference rate, you have to understand what happened several years ago, why is it they were making this move to a new reference rate, and how is that reference rate going to be selected. An important consideration when taking a look at LIBOR is that LIBOR in fact incorporates counterparty risk. There is an element of risk that is embedded in that rate. And the current proposed reference rate happens to be SOFR. SOFR, in fact, is a risk-free rate. And that is a big consideration when we're taking a look at the differences between LIBOR in the United States and the proposed new reference rate, which is SOFR. Importantly, for CLO investors, we need to take a look at the documentation. And when it was first announced that LIBOR was going to be phased out in 5 years' time, the first thing that we did at PineBridge was incorporate a new element in our document review. When we're looking at the documentation, we in fact note down what is the language pertaining to the new reference rate in a CLO. Because a CLO in fact has a maturity of about 12 to 13 years. That's going to include any kind of move over to the new reference rate. After LIBOR was announced to be phased out, the early documentation that we saw in CLOs, in fact, were quite complicated. They included voting of the controlling class, or maybe the equity class had to vote, or maybe both had to vote on what the new reference rate would be. Thankfully, documentation has evolved, and now the language you're seeing in CLOs is really quite consistent. It adopts what is going to be recommended by the LSTA, and this is really quite important. CLOs are backed by leveraged loans. We need to have a reference rate which is going to be similar in the underlying collateral in the CLO and that on the tranches on the CLO. What we do see is potentially some problems with those early CLOs where they haven't revised the language in the documentation. That's where the legal departments are going to come into play, and we're definitely going to see some sort of bustle and change in documentation for those transactions which really aren't current. But ultimately, we think that as long as everyone is prepared, the documentation is accurate, the move from LIBOR to a new reference rate should be fairly seamless.